In this video, we're going to talk about the one stock that had the biggest impact on our path to tripling the S&P 500 in 2017. Hello everyone, my name is Michael Lamott. I'm the founder of ChartYourTrade.com, and our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. Now, in last video, we spoke about 4 out of 5 losers, 4 out of 5 losing stocks. And if we had just given up there, we never would have bought the stock that ended up making us the biggest gains that we've had all of 2017. A stock that we're still holding right now. The stock that I'm talking about is Adobe. We bought it on January 19th, and we are still holding that stock today. Now in this video, I want to walk you through the entire path of that trade. I want to walk you through the pattern that we saw, why we saw, well, how much we bought, the entire trade, what we had to hold through, some of the big corrections that it did have. Some of them were pretty scary, and to give you all the tools that you'll need in order to do this yourself. So sit back and enjoy. So here's the chart of Adobe. The ticker symbol is ADBE. And what we're looking at right now is a daily chart and a weekly chart of Adobe. And you can see where we bought and the trajectory of the entire trade down here on the weekly chart. And we'll go into greater granular detail on the daily chart. That's where a lot of the decisions to enter and where to exit, and just seeing the entire pattern. We're going to focus more on the daily chart, but to take a look at the weekly chart first, let's blow this up a little bit. Entered way back here, and this line down here, this is the relative strength line of Adobe versus the S&P 500. It's telling us whether it is outperforming the S&P 500 if it's going upward, or if it's underperforming the S&P 500 if it was slanted downward. So we could see that Adobe was a leader for a very long period of time, even before we bought the stock way over here. As stocks form their base, the relative strength line typically takes a dip. And the reason why is because it's busy consolidating and the index is either chopping around itself, or it could be doing anything. But to see the relative strength line take a little bit of a dip while a stock is basing is not uncommon. So this little dip right here didn't bother us at all. Seeing this run up was telling us that, okay, Adobe is a leader, and that's one of the many reasons why it was on our watch list. Now, it formed this base here. This is a cup, and when we look at the daily chart, it's a lot easier to see that it's actually a cup with handle. And we ended up buying right on the breakout of the handle. So that's really like the classic pivot breakout of stock. Most of the time we're looking for an advanced entry point on the stocks that we are going to buy. The reason why we use the classic pivot here is because it gave us such a tight entry to exit. And that's really what we're looking for. It's not just like, oh, let's get in early. It's more like, let's get in as close to a logical support area as we can that will give us the biggest reward to risk potential. And that's exactly what we got over here. So the breakout point was right there. We got in at $111.09 on that day right there, January 19th. And our stop was at the low of the handle, which was 106.87. That's only 3.8%, right? So most of the time, a lot of people look for a 7 to 8% stop loss. Some even go as far as 10%. This is allowing us to only have a 3.8% risk on this trade. And so the way that I like to position size and I'll go through it for the sake of you that are new to me. I go to ChartYourTrade. I have this position size calculator. It's there. It's for free. I click on that, and I will figure out from there the number of shares that I could buy of any particular stock I'm interested in. So for this one, let's say that we are using a hypothetical $100,000 account just to keep the numbers nice and round and easy to look at. Typically on every single trade, I'm risking 1% of my trading capital. Sometimes it could be a little bit more, sometimes it could be a little bit less, but those are subtler nuances that are outside the scope of this. But on average, it's 1%, so we'll go with that. The entry price was $111.09, and the initial stop we had was, let's see, what was it? It was set up at 106.87. So 106.87. So we were able to buy 237 shares, a position size that was a little over 25% of the capital that we had on hand, and we're still only risking 1% or about $1,000. And so this works whether you have a $100,000 account, whether you have a $10,000 account, right? It works no matter what size your portfolio is. If you only have a $1,000 account, you could have still bought 2 shares of Adobe and still played this. So it doesn't matter what size your account is. The point is you need to go in there and participate. So we have our $100,000 account, and we bought the 237 shares, right? So let's go back, just so that way this stays there. Okay. So we bought here, our initial stop was there. I don't recall us raising our stop very quickly. I actually believe we raised our stops on this gap up over here. So in the model portfolio, we are trading on an intermediate term basis, and the way that I'm trading this is Adam Sarhan runs this model portfolio, and I have a separate account that's following this portfolio along trade for trade, and that way I can also participate in the intermediate term trends, because for me that's something that I'm still learning. I've become much better at since 2016, well, when I first started following the model portfolio, but I'm getting better and better at doing that on my own all the time, but I'm still following this model portfolio. So we enter here, and the stop gets moved up to break even on this gap up, right? So now we're at break even, and the trade continues, right? So keeps on moving along. Then it gets tested, right? This is the first like nasty pullback test of the S&P 500. So over here, just to zoom in on this, we get a quick 5.5, almost 6% pullback to the 50-day moving average, which if you trade, depending on what stock you're used to trading, that it's not really that much. But if you are looking at a stock that's really only going up, not even a full percent per day, like maybe 1/4%, 0.5% per day, that a move like that quick down to the 50-day moving average, it could be scary. But when we look at the chart, it's always good to see where it's catching support and try to figure out, well, why is it catching support over there? So it catches support at the 50-day moving average. Okay, let's take a look at what's to the left of that. To the left is this former resistance zone, right? And let's see, over here, the high of this day is $130.30. The low of this day, where it came down and tested the 50, was $130.82. So it came within about 50 cents of testing that former high. Okay, so that's going to be a good spot to raise a stop up to. And so as it reversed and continued to work higher and broke out above here, that's when we were saying, okay, time to raise the stop. And so the stop was just below this level over here. And it continued to rally, came back, shook out below the 50-day moving average. Now, if you're looking at stocks like this and you're looking at them intraday, that's a very scary move. And over here, that's about a 9% correction within a couple of days. Very, very scary move. I probably would have been shaken out of that if I was not just following along with the model portfolio and before I had this kind of experience of doing this for a few years. And so the low of this day was $131.20. So comes within about $1 or so of where we had our stop loss and continues to work its way higher, thankfully. So continues to work its way higher. Right, and so as you have these little consolidations, you're able to start thinking about raising a stop. But we're like, I believe we kept our stop, but we're still in this. So the stop would have been raised to about this point over here once we got up to, once we started to make some more progress and break out into new 52-week highs. So if we raise the stop to here, that still gives us plenty of room for this, right? So we're going along, and then all of a sudden, we get this correction down here. Another about 8% drop, right? So not as bad as the one that we saw back here, back in June. Now it's September, and we are correcting about 8%. And now we're hanging out below the 50-day moving average for a little while. That's pretty hard to stomach, especially right after it reports earnings and it's selling off on heavy volume. But we still have the 100-day moving average as a potential support area. And Adam decides that he's going to hold on. He decides that Adobe is a leader. It's been a leading stock, and therefore willing to sit with a 12-13% give back on this trade from the ultimate peak to where the stop loss is way down here. At that point, we had a run of about 44%, and we were going to see it go back down to about 25%. So that's part of what you need to do to experience these kinds of massive moves. Like right now, what are we up to? We're up to about an 80% gain on this trade, and we've been holding it for over a year. Part of why we were able to have this kind of gain is because we were able to sit through this kind of correction, and we were able to keep our stops pretty loose, right? So if Adobe continued to fall down below the 100-day moving average, maybe we tighten up the stop there. It's hard to say exactly what would have been done because, you know, hindsight's always 20/20. But I can tell you that at least at this point here, we're keeping our stops loose. And the reason why we want to keep our stops loose is because where your stop is, that's where you're going to just exit, right? So that's like the last line of defense. So if it's getting below this, then okay, that's it. Sayonara, goodbye. If it continues to work, then you'll stay in the trade much longer. So Adobe continues to run, it breaks out, gaps up higher, and then as it continues to break out, right, as it follows through, that's when we raise our stops up again, and we're using the low of the gap as our new stop loss. So runs up, then it has this nasty pullback. So let's measure this one. It's an 11% pullback, and our stop is right around $164. It comes down to $165.68. So using these kinds of support levels and looking at where moving averages are and trend lines and all this, it really comes in handy. And this over here was another advanced entry point where if you wanted to add to Adobe, you could have. The model portfolio didn't, it just takes trades it and rides them for as long as it can. Very simple, low-touch strategy. That's the one that I'm following. So in that particular account, I did not add to Adobe, but this trade was given out to subscribers to say, hey, here's another advanced entry point. If you want to enter, this looks like a good idea. So far from there, it's worked out pretty well. So that's about a 11.5% gain from that point, and you were only risking about 1.5%. So leading stocks, support levels, they work. And at this point, what were we up? We were up about 80%. So that gives us about 20 times the amount that we initially risked on this trade. And so what that means, when you have 20R, right? When 20 times the amount that you risk and you're constantly risking the same amount on every single trade, then that means that we could have a string of 20 full losses in a row, and we would still be able to break even just with this one trade. That's why it's so important to find leading stocks, be able to get in at the advanced entry point, the spot where it makes the most sense, where support is close to the entry point where we're going to get in, and then to be able to manage the trade like this for as long as you can, for as long as it's going to be able to run. And a stock like this can easily make anybody's year and pay for a lot of losses. For us, thankfully, we only had about we won on about every 4 out of 10 trades last year, so only batting somewhere in the neighborhood of 400. And with a stock like this, a huge home run still running, more than pays for every single loss, and a huge reason why we were able to triple the return of the S&P 500 last year. The gain was roughly 60% in the portfolio, for the model portfolio and for myself. So this is what you need to do in order to have those kind of returns. If you would like to test out the Advanced Stock Report service and get the model portfolio that shows all these trades and test it out for 3 whole months, use coupon code 3427, and I'll link the product page down in the description below, and just click on that, use coupon code 3427, and you'll get to test out the model portfolio and the advanced stock report service for 3 whole months for only $27. Thank you all so much for watching. I truly appreciate it. If you have any questions at all, please leave them in the comment section below and I will personally help you. Also, if you like the video, click that little thumbs up button. That'll really help us out a lot. And also make sure that you subscribe to the channel so that way you're going to get every single update. Thanks so much for watching, and I'll see you again in the next video. Take care and have a great day.